Welcome to our channel. Are you a business owner or a professional trying to navigate the complexities of the Income Tax Act? Wondering how profits and gains from your business or profession are calculated and taxed? Then stick around, because today, we are breaking down everything you need to know about profits and gains from business and profession under the Income Tax Act in simple terms. Before we dive in, if you find value in our content, don't forget to like this video, share it with your friends, and subscribe to our channel for more such insightful content. Now, let's begin. Profits and gains from business or profession, or PGBP, is one of the most crucial heads of income under the Income Tax Act. It applies to income earned through the conduct of a business or profession and plays a significant role in determining your taxable income. First, let's understand the meaning of business and profession as per the Income Tax Act. The term business includes any trade, commerce, or manufacture, or any adventure or concern in the nature of trade, commerce, or manufacture. Essentially, it covers all activities aimed at earning a profit, whether through selling goods, providing services, or any other commercial activity. On the other hand, a profession refers to a vocation, calling, or specialized occupation that requires intellectual skills or manual skills controlled by the individual's intellectual ability. For example, professions like doctors, lawyers, architects, and chartered accountants fall under this category. Now that we've understood the basics, let's explore how income under this head is computed. The computation of income from PGBP involves three primary steps. Step 1. Identify the gross receipts or turnover. This includes all income earned during the financial year from your business or profession. For businesses, it comprises sales revenue, service income, or any other earnings related to your operations. For professionals, it includes fees, consultation charges, or any other payments received for your services. Step 2. Deduct allowable expenses. The Income Tax Act allows certain expenses incurred exclusively for the purpose of earning income to be deducted from your gross receipts. Some examples of allowable expenses include rent, electricity, and water charges for office premises, employee salaries and wages, depreciation on business assets, cost of raw materials and consumables, professional fees, legal expenses, and audit charges, travel and conveyance expenses. However, remember that only legitimate business expenses are allowed. Personal or non-business expenses cannot be claimed as deductions. Step 3. Consider disallowable expenses. Certain expenses, even if incurred during the course of business, are disallowed under the Income Tax Act. Examples include personal expenses, expenses prohibited by law, penalties and fines paid for breaking the law, any expenditure incurred in cash exceeding 10,000 rupees in a single transaction, unless specifically exempted. After adjusting for allowable and disallowable expenses, you arrive at your taxable profits from the business or profession. Now, let's talk about some special provisions under this head of income. Section 44A. Maintenance of books of accounts. The Income Tax Act requires certain businesses and professionals to maintain books of accounts. For professionals, this includes a cash book, ledger, journal, and copies of bills exceeding 50 rupees. For businesses, the requirement depends on the turnover or gross receipts exceeding specified limits. Section 44AB. Audit of accounts. If your turnover or gross receipts exceed 1 crore rupees for businesses or 50 lakh rupees for professionals, you are required to get your accounts audited by a chartered accountant under Section 44AB. Section 44AD and 44ADA. Presumptive taxation scheme. To simplify tax compliance, small businesses and professionals can opt for the presumptive taxation scheme. Under this scheme, income is presumed to be a fixed percentage of turnover or gross receipts, and detailed books of accounts are not required. Businesses can declare 8% of turnover as income, while professionals can declare 50%. Let's now understand how losses from business or profession are treated. Business losses can be set off against income from any other head in the same financial year, except for income under the head capital gains. If the loss cannot be fully set off, it can be carried forward for up to 8 years and set off against future business profits. Moving on to some key exemptions and deductions specific to PGBP. Section 10AA provides tax benefits for businesses operating in special economic zones. Deductions under Section 35 are available for expenditures on scientific research. Section 80JJAA allows deductions for employing new workers in specific cases. Finally, let's address the tax rates applicable to business and professional income. For individuals and Hindu undivided families, the income is taxed as per the applicable slab rates. For companies, the tax rate depends on whether the company qualifies as a domestic or foreign company and the applicable concessional tax rates. As we conclude, remember that managing business or professional income effectively can significantly impact your tax liability. It is advisable to maintain proper records, stay updated with tax provisions, and seek professional advice when needed. We hope this video has given you a clear understanding of profits and gains from business or profession under the Income Tax Act. If you have any questions or need further clarification, feel free to drop your queries in the comments section below. And don't forget to like this video, share it with others who might find it helpful, and subscribe to our channel for more in-depth explanations on topics like these. Thank you for watching, and we'll see you in the next video.